Most traders are stuck buying high and selling low. But what if I told you that there's a strategy that pays you just for agreeing to buy a stock you already wanted and then pays you again just for holding that stock? It's called the wheel strategy, and it's one of the easiest ways to generate consistent income from the stock market. You don't need to guess market direction. You don't need to time that perfect entry. And once you understand it, you'll wonder why you didn't start sooner. Stay with me, because I'm going to walk you through the strategy in plain English, step by step, with real trades, real screenshots, and real results. Hey, I'm AK, and I've been trading options profitably for over 13 years, and inside my private trading community, this is one of the first strategies I teach my new members. Why? Because it's simple, it's repeatable, and it works, even if the market's moving sideways. And I've been able to help my members get results like these. If you're looking for a strategy that feels more like collecting rent than gambling in the market, you're going to love this. Let's dive into the wheel. The wheel strategy is a 3-step loop. You sell a cash secured put to get paid up front. If assigned, you sell covered calls to keep generating income. And once the stock gets called away, you go back to step 1. You're literally getting paid at every step of the process. Now, let me break each one down slowly, and I'll show you exactly how this works using real numbers. Step 1, sell a cash secured put. Let's say you've got your eye on Apple. It's trading at $225, but you'd love to buy it at $215. Instead of waiting around, you sell a put option with a $215 strike price, and you get paid $490 up front. If Apple stays above $215 by expiration, you keep the $490 and you don't have to buy the stock. If Apple drops below $215, you get assigned the shares, but at a discounted price you already wanted. Plus, you still keep the $490. I recently did this with NVIDIA. I sold the $90 puts, collected $942 in premium. And if I get assigned, I'd be happy to hold the stock. This is like saying, I'll buy your car for $16,000 if it doesn't sell this month. And the seller pays you $500 just for agreeing. If they don't take your offer, you keep the $500. If they do, you still get a deal that you wanted. Win-win. Step 2, sell a covered call. Now, let's say that you did get assigned the Apple shares at $215. Now what? Now you own 100 shares of a great company at a discount. Time to sell a covered call. You choose a strike price above your purchase price, maybe $230, and someone pays you another $635 for that contract. If Apple goes above $230, your shares get called away, you sell at $230, lock in a $15 per share gain plus the $635 premium. If Apple stays below $230, you keep your shares and the premium, and you sell another covered call for next week or the next month. After I got assigned on my Kava puts, I sold the $110 calls and collected another $346 in premium. Didn't have to do anything fancy, just held the stock and got paid again. This is where it starts feeling like you're collecting rent on your portfolio. Step 3, repeat the process. Once your shares get called away, you go back to step 1, sell another put, collect another premium. If assigned, sell more calls. Repeat, repeat, repeat. This is why it's called the wheel. It just keeps turning, and you're getting paid whether you own the stock or not. Now, let's talk about where beginners mess this up. Mistake number 1, selling puts on risky, volatile stocks. Stick with quality companies you wouldn't mind holding. Mistake number 2, not having enough capital. Remember, cash secured puts require you to have enough money to actually buy 100 shares if assigned. Mistake number 3, selling options too close to expiration. Aim for 30 to 45 days out. That's where time decay really works in your favor. And never forget, the goal isn't to hit home runs. The goal is consistent base hits that stack up over time. Here are some what-if scenarios I'm sure you're wondering about. What if I get assigned and the stock drops more? Great question. You only sell puts on stocks you're comfortable holding long-term. If it drops, you keep collecting covered call premiums while waiting for it to recover. Plus, you can average down if you choose. What if my shares never get called away? Then you just keep selling calls. This is a great problem to have. You're generating income every month. What if the stock takes off and I miss the upside? Yes, your profit gets capped if the stock goes way above your covered call strike. But remember, your goal is income, not catching moonshots. This is a strategy for cash flow, not speculation. Now, let me show you a few real trades I've done recently using the wheel strategy on Tesla, American Airlines, Palantir, and Google. This strategy works. It's not a theory. It's not a gimmick. It's just consistent execution week after week. Here's something most traders miss. When I'm selling puts to start the wheel strategy, I don't let my cash sit idle. I park it in a money market fund earning around 4.18% interest. So even while I'm selling puts, my cash is still working. That means I'm collecting premium from selling options and interest on my capital. This is how you make your money work double shifts. If you want to see how I run the wheel strategy in real time with actual trades, alerts, coaching, and support, join my online trading community. The link is in the description. You'll get access to my live trades, resources, and the same playbook that's helped hundreds of traders build consistent income. And if you're ready to start spinning the wheel yourself, drop a boom in the comments below and let me know what stock you're starting with. Now watch this next video where I show you how I profit from every trade even when I'm wrong.